Welcome back to Insights Now. I'm Gabriela Santos, Chief Market Strategist for the Americas here at JP Morgan Asset Management. Summer is a great time to zoom out from the day to day and zoom into a big topic that we normally don't have time to think about. So today we're really excited to introduce something special, a summer series of 5 episodes entitled Moments in Market History. In each episode, David Kelly, our chief global strategist, will sit down with one of our amazing research analysts to discuss a transformational market event, from the 1929 stock market crash to the global financial crisis. And during their discussions, David will review what factors led to these events, how they unfolded, how they eventually came to an end, and importantly, what lessons investors can take away from them. So, David, how did you come up with this idea of doing key moments in market history?
Well, I think I've been around for some of them, but I feel like I've been in U.S. financial markets and really interested in the U.S. economy since the 1980s. And then I've always been interested in history anyway. So going back to previous things that happened, going all the way back to the Great Depression, I found it interesting. But I think it's also interesting looking at the similarities, the differences in how the economy and markets behaved, and also read the lessons. I mean, one of the things I'm very aware of is finance is a relatively young business. I mean, a lot of young people here, and those, a lot of young people in this business, aren't aware of what happened then and what happened, in the past. And so I think there are lessons. There are lessons for policymakers, but particularly lessons for investors about how you should react when everything seems to go crazy. Because almost always we've seen some, not exactly this crisis before, but something like it. So what can we learn from history?
And speaking of youth, you had our young research analysts interview you about it. So, how did you get them to prep to actually come with neat
Yeah, well,
questions
that's
for you?
it's very typical of me. I think I'm firmly implanted in the last century, if not the one before. So I got them all books, and so we've got some great
Makes
books,
sense.
starting with the Great Crash 1929 by John Kenneth Galbraith, and ending with Too Big to Fail by Andrew Ross Sorkin. Just looking at the story of how these crises came up, and then how they sort of evolved over time, and then how they're ultimately resolved. Any lessons that we can learn from them.
And speaking of, in terms of these 5 crises, were there any commonalities between them and what led up to them?
I think in all cases there was a degree of investor enthusiasm or optimism
Mm.
that you can't really squash that out in America. There are always going to be people who get very excited about investing. I think another thing that was very common is the use of leverage. All of these crises involved, to some extent, leverage by institution or group of institutions, or margin borrowing, which is the same thing. So I think that's part of the story also. There's also a lot of hindsight. Maybe the authorities should have done this. Maybe the authorities should have done that, in terms of what could be done to prevent this happening again. And in most cases, to be fair, the system did evolve, and new rules were put in place to try and prevent exactly that crisis occurring. But there are many types of crises, and so over time, I'm sure we're going to be dealing with problems of speculation and exuberance and leverage again.
And speaking of the resolution of the crisis and involving an institution like the Federal Reserve have key role to play there. What do you think they've learned from
Well,
their
I,
experiences?
well, I think one thing that's happened is that over time, the Federal Reserve has gotten much more power. So, if you go back to the 1929 crisis, they really couldn't do anything. I mean, they weren't. They made loans to member banks, but they weren't really involved in Wall Street at all. They didn't have any ability to set margin requirements. That didn't come until the 1930s. They couldn't, and the other branches of government couldn't really regulate the investment trust business or the investment fund business. So that was a problem also. So really, they had a very blunt instrument at that time. They could just increase or lower the money supply, or change interest rates. But that's about all they could do at the time. And over time, they've had more ability to first of all regulate financial markets more, but also their ability to step in, and we've seen this in more recent crises, step in and actually just resolve problems before they became financial crises.
Mm. And what about lessons for investors? What are some common takeaways here?
Well, I think one of the things I am a little conscious of is, because there's lots of excitement in disaster. And so what we've had is a long period of rising markets with intermittent disasters. And it so happens the 5 episodes we talk about this season are 5 disasters. But I'm conscious of the fact that if you go all the way back, if you go 100 years ago, go back to the mid 1920s, if you'd invest in common stocks then and reinvested the dividends, you'd have made about 10% per year over the last 100 years, which is extraordinary. And if you go back over just the last 40 years, you make about 11% per year. So even though, we've had these intermittent crises and there are lots of, words of warning in these crises, I think it's important for people to be long-term investors. That's one message. Um, Another message that I think is important, which again is sort of investing principles, is don't worry too much about timing the market. Uh, when we're talking about the 87 stock market crash, on October 19th, 1987, the Dow Jones Industrial Average fell by over 22%. The S&P fell by over 20% in one day.
Mm.
And what I thought was one of the most remarkable statistics is that if you had bought stocks at the worst possible time, which is the Friday before it, and then you watched the Dow fall 508 points, you felt sick to your stomach the next day. If you had done that, by now, almost 40 years later, you would have made an annual compound return of about 11.1%. If, on the other hand, you'd been a genius and the bravest man out there, and at the bottom of the market on that Monday, when the market was down 508 points, you'd bought then, you'd have made 11.9% compound return over the last 40 years. So either way, you'd have done really well as a long-term investor. Don't think you can time markets. You don't really need to time markets. Long-term investors really should be long-term investors. So I think those are some of the positive messages. And of course, the negative messages are, or the things to avoid are, 1, avoid leverage. 2, don't get over excited about things you don't understand, particularly in the internet bubble. We saw a lot of companies which were just obviously mispriced, but people just got too excited about them. And then also, and this one came up with long-term capital management, be very careful that diversification actually means what you think it means. Because we've seen this before. I remember in the tech bubble, we saw people buying growth funds from a whole pile of different fund companies who thought they were diversified, but guess what? They're investing in the same stocks. In terms of what happened with long-term capital management, we had all these risk on trades fail because they were all basically based on convergence of spreads. And when the market went risk off, everything went wrong at the same time. So correlations can go to one. So you have to think very carefully about how diversified you are. And even today, we were talking about this just yesterday, I remember. When you look at international investing today, you need to make sure that you are actually truly diversifying your portfolio by international investing, or are you just investing in the AI theme in different markets? And, what is true diversification? And true diversification today means a very, very broad set of assets.
It can be really hard to tell in the moment. But I
Yes.
think it's interesting, David, that going through these 5 crises in depth, the conclusion is still not to be front running the next one by staying on the sidelines, because there's a real opportunity cost.
Well, that's right.
And I think in the here and now, we do often get the question, well, do any of these resemble where we are right now? Is there anything that's a bit concerning for the moment?
Oh, yeah, there are. I think first of all, valuations are very high right now. I mean, if you looked at the Schiller PE ratio on a lag basis, it's pretty close to where it was. It's higher than it was in 1929. It's pretty close to where it was at the peak of the dot-com bubble. So that's one thing. You've got to watch valuations. I think you've got to watch leverage. And leverage comes in many shapes and forms. But are you, is a company over levered, or is the way you're investing is over levered? I think that's another thing. You've got to watch for a lack of regulation. People invest in crypto today because it really should be, in my personal opinion, should be regulated out of existence. But if not, it should be very heavily regulated. But people always talk. I remember after the 2008 crisis, people talked about moral hazard and how things should be. Nothing should ever be too big to fail, and drawing lines in the sand, and being tough. You don't need to be tough in a crisis. You need to be tough in the good times. And we can see a lot of failures of regulation, failures of discipline today. So I think you've got to be aware of all of those. But there are differences from every occasion. I mean, in 1929, we had a stock market crash, but we had a very fragile banking industry which collapsed, leading to deflation. We also had policies we had tariffs. Now we have that again today, but we also had a policy to firmly balance the budget, which was counter-cyclical and hurt us then. I don't think for some reason we're going to
not
make that
getting there.
mistake again.
Yeah.
So I think you've got different lessons from each of these episodes. And that's really why we recorded all 5 episodes, because each episode has a little bit of extra information for it. But I think there are similarities and there are differences. I think, one of the differences, for example, with the dot-com bubble is there are a lot of internet companies right then they didn't really have a lot of cash. And so there's a big investment boom, but there was nothing really behind it. Today, the hyperscalers have got tremendous cash flow from their legacy businesses, which support the direct purchase of or direct capital spending, but also allows them to lever up themselves in a reasonable way to support further spending. And then finally, particularly when you've got a technology revolution, as in a way we had in the 1920s, so we had in the 1990s, we have today. You don't know who all the winners and losers are. And so I think it's important to be humble about that. Don't get over concentrated. Do think carefully about what you're buying.
Yeah, and even if you're not sniffing out another crisis, there are still really important takeaways.
Well, yeah. And the one other takeaway I think is very important, I was particularly thinking about this in the 1930s, is that of all the crises, that one was the most miserable one because the stock market fell by 89% between 1929 and between October of 29, August of 29, and then August and then July of 32. So in almost 3 years, it fell by 89%. If you were in stocks, and particularly if you were levered in stocks, you were ruined. But if you'd had half your portfolio in bonds, treasury market was fine. It would have been painful, but it wouldn't be that painful. You made a little bit of gain on your bonds. You could have made money out of deflation. You would have been fine. And that's why it's so important. I mean, people are so disinterested in fixed income right now because, frankly, the stock market is so exciting. But boy, it's so important. Have something that is really fixed when the world turns to turmoil.
Yeah, diversification doesn't feel good maybe in the moment when things are going really well, but it certainly pays off.
If you're really excited about everything in your portfolio, you're not diversified.
That's a good point. David, I have a bonus question for you. So out of these 5 books, 5 episodes, if listeners and viewers want to do a little summer reading of their own, what's the one favorite book you have?
I think the one about is called The First Class Catastrophe by Diana Hendricks about the 87 stock market crash. I never read that book. I never even heard of it before, but I want to get a good book on it. And what I love about that book is it starts in 1980 with the Hunt brothers and cornering the silver market, but it goes through all of the institutional weaknesses that essentially set up the bomb and primed the bomb that blew up the market in 1987. So I think I probably learned more about that from that book than any of the others. So I think that was a really well written book and very interesting.
Not one to skip then.
Yes.
Well, thank you so much, David. And thank you for listening and watching. Make sure to check out our upcoming Moments in Market History summer series, which will drop right here in this feed. We'll see you soon.
This material is for information purposes only. The views, opinions, and statements of financial market trends that are based on current market conditions are those of the speaker and may differ from those expressed JP Morgan Asset Management or by other areas of JP Morgan Chase & Co. Any companies referenced are shown for illustrative purposes only and are not intended as a recommendation. We believe the information provided here is reliable, but should not be assumed to be accurate or complete. The views and strategies described may not be suitable for all investors. This content is intended for information only based on assumptions in current market conditions and are subject to change. No warranty of accuracy is given. This content does not contain sufficient information to support investment decisions. It is not to be construed as research, legal, regulatory, tax, accounting, or investment advice. Investments involve risks. Investors should seek professional advice or make an independent evaluation before investing. The value of investments and the income from them may fluctuate, including loss of capital. Past performance and yield are not indicative of current or future results. Forecasts and estimates may or may not come to pass. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.